Hello and welcome everyone to the Capital Mind podcast. If you'd like to know more about us, visit capitalmind.in, and if you'd like to invest with us, do visit capitalmindwealth.com.
This podcast is for informational purposes only and should not be relied upon as the basis for investment decisions. Clients of Capital Mind may maintain positions in the securities discussed in this podcast.
Hi everyone, and welcome to episode 37 of the Capital Mind podcast. It's a bit worrying out there when we look at the number of COVID cases. That graph looks awfully steep, and I guess we're now in the nth wave right now and just waiting to see how this pans out and whether vaccinations will get into hands fast enough or not. But as we look back at this year, which is still surprisingly 5.1% up on the Nifty, as Deepak just showed me, we're starting to see some signs that don't look all that happy in the financial markets. And so, while all of us are sitting and worrying about what maybe the next crisis in the health system could be like, we thought we'd just take a critical eye at the last couple of months and try and look at what could be some potential risks or cracks in the financial system. So Deepak, welcome once again. And as you said, we're going to start off with 3 stories, which is actually one of my favorite House MD episode titles. So let's hope that this episode does as well as that one does. So Deepak, let's start. 3 stories, you said, right? That's how we'll start. 3 stories of things that have happened since the start of this year, in fact, and which might talk about what is a somewhat more fragile system than we thought it was. Please take it away.
Yeah, I mean, thanks firstly, Shray, and I really hope the cases part, the health system does not have the same kind of issues as the financial system seems to. And the first story I'm going to talk about is one that's been made famous by the Reddit crowd, the subreddit crowd of GameStop. Of Wall Street Bets, yes. Of GameStop, really. And, the system, that's the weirdest part of that system is that you would not imagine that a small thing like GameStop would impact the world's financial system in any meaningful way. And, it's really so small. But then you see these little things, and I'll take you through the story. So it started off with this system where you've got a company called GameStop, not particularly doing so well, but not particularly doing so badly either. You suddenly find out that there are people, certain hedge funds, which are short 140% of the stock. This sounds like, okay, big numbers, but what does it really mean? Now, if you have a company which has about, say, 5 million, 50 lakh shares, it has 50 lakh shares. There are 50 lakh shares, voting shares in the market and so on. But I own those 50 lakh shares. And you decide that this company called GameStop is going to go down. And you say, listen, Deepak, can I borrow 10 lakh shares, 1 million shares from you? I say, fine, you'll pay me some fee. I'm very happy to lend it to you, or I'll lend it to you. You go and short sell this stock in the market because I've lent it to you. Mm-hmm. And then somebody else buys it. Now, I think I own 5 million shares. You've sold it to somebody else, and let's call him Vashisht, and Vashisht owns 1 million shares. So I own 5 million. I think I own 5 million. Vashisht owns 1 million.
Oh, so
there's 6 million shares in total, right? So now I have 5, he has 6, but there are only 5 million shares ever issued. This is a 20% short interest. Now imagine this at 140% short interest. It effectively means that there are 7 million shares short of a company who has only 5 million shares in existence. So there are 12 million people who think they own shares of this company called GameStop. Why has this happened? It's inherent leverage in the system. This is a leverage system, right? So when you have 5 and there are 12 that actually exist, it's inherent leverage. It's allowed in the US. It's not allowed in India. India's regulatory system in this is far, far better. So for a 5 million share company, you couldn't go more than 5.5 in total interest, which means only 500,000. 10% of it can be shorted. Then maybe
a little less than 140%.
Yeah, a little bit less. I mean, So, but I would say restricting leverage even to 20% was fine. In India, you can do 10% in futures, 10% in short. So you could do 20%. But that's it. So America has no such problems. This inherently created leverage. Now you find out that these people are short. And how are they short? They borrow shares, they pay a small fee, and then they short those shares in the market. They use that money to do other things. Now, in general, there's a lot of leverage involved here as well. So the guy who shorts 5 million shares does not pay 5 million shares worth. He does not put as much as 5 million shares worth. He puts only perhaps as 1 million shares worth. So he's further leveraged 5x. Now, people at Reddit figured this out at Wall Street Bets. They said, listen, you can't have a company with 140% short exposure. This makes no sense at all. So maybe that, maybe some other rings. They said, let's, you know what? If these people are so badly short, if the stock rises a little bit, the short people are going to be making losses.
Yeah.
And in typical short squeezes, and we've talked about this in the Reliance episode before this and all that, in a short squeeze, the guy who's short has to buy back shares. So if you raise the stock price up, the short guy gets squeezed out and has to buy at a much higher level, makes losses and so on. The interesting thing about this is the subredditors, now typically hedge funds play these games, but the subredditors, was a retail individual, started to play the game and said, let's take the stock up. So GameStop from $20 a share started to move up to 25 and 30 and so on. But this was another interesting point. They didn't just take down the fact, go by the point of saying, I'll buy shares of GameStop. They started to buy options of GameStop. So options are a leveraged creature.
Again.
Right. So now I could say at $20, give me $50 options. That means strike price of $50. Options of GameStop, which means I don't get paid until GameStop crosses $50. Now, who's on the other side? The guy who sells me this option is probably a market maker from a large broker or from a large, either a hedge fund or from a prime broker. He's or from one of the big banks. He's looking at this and saying, listen, Deepak says he wants to buy $50 strike options of GameStop and he's willing to pay me $5 for this. I'm happy to do that. Guess what? I will sell him these things. But what if GameStop actually goes from 20 to say $100 for whatever reason?
Yeah.
I might lose a truckload of money.
Yeah.
So let me do this. I will do this hedging by buying shares of GameStop equivalent to the position that I would lose. And by a complicated mathematical formula, they'll say that, listen, if I've sold Deepak $100 shares worth of GameStop options at some at a $50 strike price, because the strike price is $20, it's 40% of the overall thing. A rough calculation, I will buy 40 shares of GameStop. Now think of this, I pay say $100 for this option, and this induces the market maker to buy about $1,000 worth of shares of GameStop. So effectively, my $100 forces the market maker to buy $1,000 worth of GameStop shares. GameStop goes up to $25. Market maker says, oh my God, I need to buy more shares because now I'm closer to the strike price. He buys another $500. And then it goes to $30. He buys another $500. So my $100 of buying has pushed the market maker to himself put $2,000 or $3,000 worth of money behind just to keep his position hedged. And why would he do it? Well, he's earning $100. Even if he puts $3,000, interest rates are very low across the world. If he puts $3,000 on this position and he earns $100 of premium, as long as GameStop is below $50,
he's fine.
He's fine. He's made 3%. And you know what? Even if it goes above, he's fully hedged. So he's fine again. So he still makes that 3%. He's fine with that. But what this has done is my $100 has forced him to buy $3,000 worth of GameStop, a 30x position. Hundreds of subredditors figured this out.
So that's a lot of leverage created.
Yes. So they've just gone in and bought options, and that options has taken the price up, and $20 became $350. At $350, a number of these hedge funds that were short GameStop obviously lost their shirts, because at this point the stock price is so high that their positions are losing money every single day, and they're on the other side, they're leveraged themselves. Remember, 1:5. And their brokers are telling them, listen, if you don't cut your position, you got to pay us a truckload of margin money. So how do you cut a position or get money? If you're long, if you own stocks, you sell them.
Yeah.
If you're short stocks, you buy them. So by the time it hits $250, they've been told, listen, you got to put up margins. They go and say, no, we'll cut our positions. They buy stock. When they buy stock, the stock goes to $350. It causes a mini crash in other stocks also, because while they don't want to buy GameStop, because buying even a little bit of GameStop is taking it up $100, they sell what else they own. So there's a mini crash in some of the big stocks as well. All because some people in a subreddit figured out that somebody is levered like crazy. They levered themselves up by using options, added so much leverage more to the system that it brought a lot of people nearly to bankruptcy.
One question that comes to mind is, I do understand the players you've mentioned so far, but when I look at it, one of the people who came out looking very poor in this episode was Robinhood, the brokerage. So where did they fit into this, and how were they squeezed?
Yeah, it's amazing, because what's happened after Madoff in 2008 was that people started to say, listen, we can't allow brokers to use their client money as collateral for their positions. In the US, also like India, there's a T+2 settlement mechanism, which means if you buy shares today, you get shares 2 days later. Unlike in India, by the way, if you take a position and now, of course, the 2 days, there's a risk. Who handles that risk? The answer to that is, if I buy shares and the other side doesn't deliver shares, then there's an auction mechanism. The stock goes into auction, the auction is played through, and whatever is picked up in the auction, the shares are given to me, so I don't lose money. If there's nobody available to take shares on the auction, then the money plus 20% as a penalty is given back to me. So I paid my money and so on. But there's still this factor that there's a 2-day lag. How is that solved? In India, they created this rule that said, well, you know what, you shouldn't use client money, but and why shouldn't you use client money is because Karvy mishandled client money and use client shares and perhaps client money as well to use as collateral to borrow for itself. So even in India, you can't use client money, but there's a little bit of an exception, which says if you're paying for a share, you can pay in with the client money on the same day. Otherwise, the broker's funds are blocked. Okay. In the US, there's no concept of this early pay-in concept. So the broker Robinhood has a lot of customers who are sub-redditors. They go and buy these shares. Now, because the US does not have this early pay-in concept, the broker Robinhood has to place a has to cover for those 2 days of risk
and cough up money for that.
So what happens is, there's a clearing company in the US which is used by a lot of brokers, and the clearing company says, well, Robinhood, if you're clearing with us and you're buying and a lot of your customers have bought this share, how are you going to assure us that should the other side not pay up, you're able to buy those shares in the market? Well, Robinhood says, well, fine, I'll pay you some margin. And this margin is based on the volatility of the underlying stock. But GameStop stock is going up from $20 to $40 to $80. So it's going up 100% a day. So the market maker the clearing agent is probably saying, listen, you can't just give me like $1 or $2. You got to give me $20 as margin just to be able to keep these positions on. Robinhood doesn't have the money because it never estimated that it would have to deal with so much collateral. I
thought it was a marketplace in a sense.
In that sense, the Indian system is far superior. But of course, we've just had a Karvy, so we shouldn't say that it's phenomenal. But I do think that over here, at least the leverage was restrained. So what happened was, Robinhood, unlike the bank brokers, did not have access to insane amounts of capital. So the big broker broker dealers like Goldman or any of the others wouldn't have had this problem, but because they have access to funds. But unfortunately, Robinhood did. And so it had to go suddenly and borrow money and
stop customers from buying more and so on.
Yes, it had to stop customers from buying more because for every new share that was being bought, they had to put in their own capital. The problem with this whole system was, it started off with one form of leverage and another form of leverage that countered the first form. And now suddenly the broker gets impacted. The broker himself, which is levered maybe 4 or 5x because he has to put margin against trades that are happening, suddenly gets a margin call because stocks are going up too fast. So Robinhood then has to raise capital, has to dilute himself. He had to raise $1 billion overnight just to survive. This was a very interesting point because it was the fact that nobody even knew that this entire system was leveraged to this extent. right? And we'll hold that thought because at some point this will come back to us in multiple ways.
The words "who knew" are going to be repeated a few times in this podcast.
Yeah, it's amazing because GME itself is not a stock worth talking about in any meaningful way. And there is no reason why a GameStop should bring a financial system, a Robinhood, even an interactive brokers to a halt. And the answer seems to be it did. This was because of this crazy levels of leverage by the hedge funds, by the financial system, by the redditors through options, by the market makers of those options. Everybody indulged in this form of leverage that magnified a problem that was maybe $1 billion or $2 billion in size to $50 billion. And we'll keep that as a note because this happened in February this year.
Yes. So I think the second story you wanted to talk about was Greensill, right? So how did that pan out?
So interesting concept again. So Greensill, if you remember subprime, the idea was that people were subprime. They didn't have enough money to pay loans. But if you somehow combined all these people together, they would somehow not default on the loans
or at least not at the same time.
Not at the same time. And then you put them together, you package them as a security, you sell them to somebody, that somebody says, well, you know what, I'm not buying just one such security, I'm buying 10 of these different pools of security, as if buying 10
bad loans is better than buying one bad.
Yes. So somehow it, and the credit rating agencies were complicit, etc. What happened in Greensill was that it financed something called receivables. That means if you as a company were, let's say, saying, oh, well, Nike has to pay me $100 million. Why don't you give me a loan, say $90 million, and take my $100 million receivable from
Nike in 6 months when they pay or whatever.
Months, and then you can keep that entire $100 million.
That sounds like a great business, as I keep saying.
It's fantastic because sometimes you can get upwards of 18-20% because put to another way, if my profit margins are 20%, I could reduce my profit margins to 18% and give you those remaining 2%. If that 2% comes to you in a month, it's effectively a 24% interest on return on the money. So you're fine doing that, except Greensill was financing a bunch of companies, and one of them was this company called GFG by Sanjeev Gupta, the steel magnet and aluminium and alternative energy and all sorts of things. Bid for a bunch of companies in India as well. The interesting thing about this was they would be receivables from that GFG would get financed from Greensill. And how would Greensill finance it? It went to banks like Credit Suisse, which created a structured product to buy out these receivables, which were packaged into a securitized product, similar to the way subprime loans were packaged. So Credit Suisse sold to its customers a fund, and then on top of that gave Greensill a loan of $140 million as well. That money was used to pay GFG for its loans and a bunch of other people. Well, it started in a weird way where one company in Australia said it will not insure the loans that GFG had taken, I think, or Greensill had taken, one of the securitized products. This caused a lot of investors to lose interest in that product because without the insurance, it wasn't as attractive. Okay. At the same time, a German regulator called BaFin said, listen, who are you financing these receivables off? And can you really tell me for sure if this is real? And they go in a little bit deeper and find out GFG has actually put receivables into these securitized products where they started billing customers before they were allowed to.
Let's call it slightly aggressive accounting, if you may.
Well, yeah, I mean, until we find out otherwise and we can name that this was actually illegal, we believe that the problem was that they were aggressively accounting it. Fair. BaFin came down heavily on Greensill and said, listen, either you put in more margin for these loans or don't do it. The problem now was suddenly Greensill blew up because if it wasn't able to raise money from the likes of Credit Suisse, it wasn't able to finance GFG and it wasn't able to earn anything, and therefore it said, listen, we're done. GFG, which is the recipient of this effectively leveraged trade, is suddenly in trouble because it doesn't have money. It announces publicly that, listen, if Greensill kind of financing is not available to it, it'll go belly up. Oh. So you've got a system that didn't seem like there was leverage, but there was leverage all over the place. There was a fact that somebody was giving money. So a Greensill, a GFG could continue to pretend they were deliverables. Greensill would continue to roll them over forever. Whether those receivables came or not was not even the problem, because you could finance a receivable by giving that receivable more money.
Yeah, okay.
Right? So effectively you could keep rolling it over forever and it would look great until somebody found out and the shit hit the fan, and this leverage was inherent in this entire equation. It's hit the fan. Again, isolated case, you shouldn't have a problem.
Yeah.
But suddenly you're seeing this problem, and this happened in February and March of this year. And you're like, why is this happening now? Why is such a small problem creating such a big...
Yeah, this keeps coming up in the Financial Times with some political affiliation. All I've never been able to quite understand it, but I get your point. It's again feels that it should be small.
It should be small, but it's the third story then makes it even more interesting.
Yeah.
Which is the
well, this one at least had big numbers on day
Yes.
one. Yeah.
So Bill Huang, a Tiger Cub,
Yeah.
a guy who had made a lot of money for Julian Robertson's Tiger in Asia, I think. They had to shut down Tiger Asia Capital after there were some insider trading cases against them and so on. So he went in and said, let's become a family office. Now, a family office is a weird extra that's allowed. They don't necessarily have to disclose their own positions with anybody, simply because they're a family office and privately owned, and therefore no public money is involved.
Yeah, I think it's your money. You do what you want. Yeah.
So let's say I'm a family office and I come to you and say, you're an investment bank, and I say, listen, I want to buy a certain stock, and maybe it's called Viacom CBS, it's called Discovery Channel, or whatever it is. I say I want to buy the stock, but you know what? I don't want to buy the stock. I want you to pay me $1 if Viacom goes up $1, and I will pay you $1 if Viacom goes down $1.
There's a name for this, right?
In India it's called dabba trading.
Okay.
In the US, it's called bucket shops. So you don't actually have an underlying position. The other side says, listen, I'll pay you if it goes up or goes down. And typically people lose money. But so, the dabba shops, and if people don't lose money, the dabba shops vanish.
Yeah, okay. Also, here we're talking about a fairly sophisticated...
Yes, and dabba trading is illegal in India. So are bucket shops in the US. But bucket shops with people wearing suits and ties like Goldman Sachs is allowed.
Fair enough.
Because people wearing suits and ties can never get you wrong, right? I mean, you're always on the right side of the financial system if you're wearing a suit and a tie. But the point here is, what would happen was a Goldman would look at this and say, well, fine, I'll pay you $1 if Viacom CBS's stock goes up. You pay me $1 if it goes down. So how much are you going to give me? He says, well, I'll give you $1 million. Well, if I give you $1 million, I'll buy $1 million worth of Discovery shares. No, you got to buy me $5 million worth. So you give me, don't worry, if Viacom goes up, you're paying me $1. If it goes down, it has to fall 20% before I lose my capital. So why don't you give me your 5x leverage? Goldman and Nomura and Credit Suisse and Morgan Stanley all said, yes, well, we'll do it because there are lots of fees here we can tack on and, make lots of money. Viacom's stock goes up 75% between January and March.
And this is perhaps from this person's buying?
Yes, and here's where it gets peculiar. 29% of CBS stock Viacom CBS stock was owned by the banks. Now, typically a bank, why would a bank own this kind of stock? The answer was, when I tell you that you're a bank and the stock has to go, if the stock goes up $1, you have to pay me $1. And if it goes down $1, I'll pay you $1. The bank has to hedge its risk. It then goes on its own book and buys the shares
as
of
the
hedge. If I were to set up a position which was 28% of a stock by buying it directly, I would have to disclose the hell out of myself. So I'd have to tell them at every 5% and then every 1% increment that I'm buying more stock. But if the bank does it as a hedge against positions that its clients have, nobody asks questions because banks do this all the time. Except there was a stock, I forget the name, I think it was GLG.
It doesn't matter.
Something like that. And where the banks collectively own 60 or 4% or something.
Sounds a bit high.
That stock. No, you can't have a set of banks owning 65% in the stock. You are the market. There's no... So the banks kind of realized this, got together and said, listen, can everybody tell each other our positions and who is the end client here? They figured out it was Archegos Capital, which was this family office of this guy called Bill Huang, and everybody knew who he was. Goldman and Morgan took the route of saying, I don't care what happens now. This is too much of an exposure, and either Bill Huang gives us more money. Now, what was Bill Huang doing? He was saying, boss, I took this stock 75% up. So if I give you $100, you give me $500 worth of stock equivalent derivative called a CFD, contract for difference. You then went and bought stock. I don't give a shit because I am like, okay, boss,
I've got my exposure.
I have got my exposure. You give me $500 of exposure, stock's up 75%. So by now you've paid me another $375.
Brilliant. Yeah.
And I have taken the $375 and bought another 5x worth of the same stock.
Okay.
So now I have 375 plus 100 is 475 into 5 times, nearly $2,500 worth of stock that you have in your name, but I am getting exposure to it.
Well, this stock had better keep going up, right?
Except Viacom CBS said, listen, people are going mad about our stock. Why don't we just issue some more shares because we really need the money?
Yeah.
They announced a stock offering. At the same time, a bunch of other things happen. When people hear about the stock offering, the stock price starts to fall.
This happened to Tesla also, Paul.
Yeah, I mean, at that time.
And they seem to defy gravity incessantly. So
yeah, so interestingly, Tesla's had multiple situations of a similar kind. But to come back to this, these stocks start to fall. And when they fell about 10 to 15%, these banks got together and said, what's our real exposure? Then, somebody must have tripped a fuse and said, come on, guys, we can't be owning 64% of a company against one guy's positions. Yeah. That guy owns 64%, but he doesn't because we own it on behalf of him, but not actually for him because we have a CFD against this. They said, listen, we got to liquidate. What Credit Suisse and Nomura said was, let's talk to Bill Huang. Negotiate. Maybe he'll bring in the money. Maybe he'll do something else. What Goldman and Morgan said was, we're getting out. They've learned from the subprime crisis, the first person to get out is the best person to get out. So they just dumped the stock as fast as they could. The stocks fell 30-40% on a single day.
Wow.
And Nomura and Credit Suisse were left holding the bag. I think they each have a $2 billion hole.
I guess we'll find out at the end of the quarter, right? Oh, the quarter's over. We'll find out.
Soon enough. So the interesting thing is, this leverage is completely unknown. A bank owning 68% is not forgivable, especially if it owns it against the same person's exposure and they didn't have any disclosure requirements. So you have this massively leveraged position. You've had a person with $8 or $10 billion worth of stock, of money, which has been levered up 5x. So it's $50 to $60 billion. Now, 50 to 60 is a serious amount of money. And whatever you say, it can bring down a lot of the financial system just by being what it is. This may not have resulted in a massive crash so far. But think of this. You got a GME, you got a Greensill, and you got an Archegos in 3 months. And in those 3 months...
each time you're looking at it and saying one-off.
And, it's like... Yeah. So, is it really one-off? Is it a sign? And is it a sign of something that is deeply embedded in our system, which we don't realize, and it's coming out, that before a volcano, there are these little earthquakes. And eventually, the final thing comes out. But anybody who knows volcanoes erupting knows that the earthquakes are the signal, not that suddenly you have a volcano erupting.
Okay, I had no idea about this, but I will go and Google it after this. But I get you. I'd like to make a quick digression here. You were mentioning that India's regulatory framework is far superior. I mean, I know obviously things can go wrong here as well, but at least on the identifiable risks, we seem to have done pretty well. You had made it clear on GME, where you said we have limits on how much leverage can be there and short interest can be there in a stock. And it's not left to the broker necessarily to, the broker has that early pay-in facility and then there's someone else behind them, some centralized agency who can handle this. On Greensill and Archegos, could you tell us how does India sort of help make sure that doesn't happen here?
So to that extent, for instance, Archegos, the issues are different in the sense that you've had a system where you have these contracts for difference, and In India, you can't. A bank cannot even own more than 10% of a company. Banks together collectively, if they own so much, you'll find out in regulatory things, and people will talk about it. And contracts for difference in general, like this, will be caught very early by the banking system itself. The similar and Greensill also, like for instance, if you don't have cash flows at all, the banking system has connived to reduce that kind of leverage quite substantially, but by different mechanisms. So you have large corporate exposures, they are shared between the banking system, and banks know that a company has loans by somebody else, and some of these securitization products aren't allowed in the format that they're allowed in the US and the West. So a lot of our regulatory mechanisms reduce the impact of some of these leverage. So by just bringing down leverage, so saying, oh, you can do this, but you can do this only 20%. And people are like, oh, come on, 20%, what's the point? So they don't do much of it. But the point is, it protects your system from having people with 140% shorts, with Greensill level of refinancing receivables forever, and so on. So that part is one. But the important part is this. Despite India having the regulatory framework to address these, and having just gone through a Karvy, having addressed it in a different way, no rules in America have changed. So you still have the possibility of 140% short, and you still have the possibility that swaps like Archegos are not required to be disclosed. They haven't changed the rules. Although the shit has just hit the fan, how long does it take? And if it takes long, are there more things waiting in the ranks?
So that was actually, I think, the next point you wanted to say, where without being overly dramatic, you were saying this is how things felt in 2007 in that regard. There was one bad incident, couple months later, another one. Each one is reasonably dealt with by the regulator at the time or by the market participants at the time. But eventually it just cascades and becomes bigger and bigger, and then eventually everything falls apart. Just wanted you to talk a bit more about that. I mean, what happened then?
So yeah, I mean, where we started off in 2007 was system where in 2005 housing prices peaked. Interest rates started to go up roughly in 2006, and in 2007 something strange was happening. The stock markets were going up, the housing prices were kind of flattening out, and a certain set of products called subprime loans, which were being packaged into these securitized MBOs and not MBOs, what is it called?
CDOs?
CDOs,
Yeah.
and mortgage-based... MBS, yeah, yes. Mortgage-based securities. So MBS and CDOs were being bought by everybody, all and sundry, including some money market funds. Typically equivalent in India would be a liquid fund or a really short-term money market fund. These are funds which are not supposed to go down any day.
Yeah.
So what would happen is all these funds would have an NAV of $1. And when they went up, they would pay a dividend equivalent to how much they went up every day.
As opposed to letting it
appreciate. And then it would, every day the value of it would be $1. Okay. Two funds from Bear Stearns, which were invested in apparently some of these subprime securities, went below $1 because the value of the securities they held fell, because the underlying loans of them were starting to go bad. The mutual funds, which were not supposed to lose money, started losing money, which means they broke the buck. This was July 2007. Everything was hunky-dory. Two funds go down. Everybody's like, excuse me, you're not allowed to see this happen. How can this happen? Oh, we'll rescue this, we'll do this, we'll stop redemptions. Everything was quiet for about 6 more months. In 6 months, Bear Stearns goes bust because of its exposure to subprime. Everybody looks at it and says, well, we got to rescue it. We got to do something. Oh, no, we won't rescue it per se. We'll let the shares go down. Let's JP Morgan take over the company. Meanwhile, India's stock market crashes 40%, then comes back up 35%.
Oh, I didn't
So
know
we're
that.
nearly back up to the same point in March when JP Morgan makes this offer of $2 a share, and the Fed chair says, no, you got to pay 10, and he pays 10, and again, everything's fine for a couple of months. Now you're seeing chinks in the armor. Something's wrong. Subprime is going seriously down, and it's hurting to the point where me as an external tiny little observer in India was saying that this crazy stuff is going to hit the fan next year. And that was November 2007. by about July 2008, you had to started to see this go across the system. A lot more banks were impacted. People are talking about the failures of various financial institutions by October. Now, this is, remember, the first signs of these things had come in July 2007. It took till September 2008 before Lehman went down. Lehman went down, MF Global went down, Morgan Stanley.
And then everything happened in a hurry.
So, not Morgan, well, I think
no.
Bank of America and Merrill Lynch merged and a bunch of things. So, great financial institutions were on the verge of dying. And it wasn't sudden. Everybody knew it for roughly a year before that. And you were seeing signs and seeing cracks in the system. Our current problems, which are small otherwise, isolation, you can, GME, oh, big deal. Greensill, oh, big deal. Are these signs of a damaged financial system that is so terribly fragile that tomorrow a slightly bigger disaster can easily come and crush us back to the same kind of levels? Maybe not as deeply as Lehman going down, because nobody's going to let a big financial institution go down anymore, but deep enough to hit us financially, unlike COVID hit us with health-related issues. But will this system, as a financial system itself, hurt tremendously? And I keep giving these US examples, but I can tell you this. If the US system has an impact, then even if it sneezes, India will catch a cold.
Yeah, I think you had mentioned that even though we have made very significant efforts to have stronger regulatory frameworks, less leverage and so on, we're not immune. We aren't as strong an economy in the first place. But in addition to that, there is undisclosed leverage here as well. Isn't that right? I mean, what comes to mind when people think about the undisclosed leverage in India?
Yes, this is the interesting point. Let me give you one example. So we've talked about the undisclosed NPAs, for instance, which has been recently overridden by the Supreme Court. And it's possible that the Supreme Court's decision will cause India to reveal the true nature of NPAs that they are. Even the RBI is saying, listen, we're at 8 lakh crores of NPAs, we're going to be at 13. Now, 5 lakh crores is a lot of money. And we know this. This is not undisclosed. This is available to us and we know it and it's coming. The point is, what is undisclosed? I'll give you an example. So, if I have 100,000 shares of TCS, I might say I have 30 crores because it's 3,000 rupees a share. I have 30 crores worth of money. I don't want to sell my shares of TCS and lose the exposure. I want to still own TCS, but I want some money for maybe a year to borrow against it. They say, well, who's going to give me money to borrow against it? The answer was, well, you could go to a bank. You go to a bank and the bank says, listen, my max is 10, maybe 50 lakhs, or nothing more. And I'm like, dude, 50 lakhs. So that's not even going to make my, I can't even invest in a Swiggy anymore. So there's no point. So I move away from that and I go to an NBFC. NBFC says, fine, you know what? You give me 30 crores worth of shares, I'll give you 15 crores.
Little better.
Little better. But you're thinking, okay, why only 15? I have 30 crores worth of shares. Why are you giving me just 15 crores worth of money? I want more. How do you get any more? So before a few years earlier, you would have the ability to issue a bond against which you say, I have 110% of stocks. So there was a guy called Subhash Chandra who owned a company called SL. He still owns it and he's still there. And his company SL went and said, listen, we own ZTV shares and we own Dish TV shares and we'll take 100 crores of a loan and we'll give you 110 crores of Z and SL. A lot of mutual funds, Franklin, HDFC and ICICI Prudential, all of these guys said, oh, well, no, such a great man, Subhash Chandra. Why will...
Good company.
Good company. Yeah. So, you know what, no loans and all that. But yeah, the SL company wants some money. So why don't we give it to them? Okay. And then shit hit the fan. The stock
this was
fell.
Done out of respect for promoter and the fact that the company is supposed to be a good company.
Plus, I have collateral of 110%. Yeah. But the point is, nowhere else were you getting this...
good deal.
I have 110 crores, I can get 100 crores of cash from it.
Got it.
The problem was when the stock started to fall, a few mutual funds like Reliance sold it. The rest of them tried to make a deal. They did all sorts of things. They eventually did get most of the money back. But in the process, the stock had fallen quite tremendously. these, when the shares fell, if you give me 110 crores worth of stock for something that is, I have given you 100 crores against, then the stock falls 10%. I now tell you, listen, you got to give me another 11 crores because I still want to make 1.1x. You don't have that 11 crores of cash, or you're going to give me more shares. If you don't have either, then I'm the one who's hurting, not you. So when people did this tremendously and over time, you had a system which was allowing people to borrow too much money against stock. So what SEBI did was said, listen, we recognize this has happened in the past, but the max you can do from now on is the minimum you should have is 2x. Okay. Which means if you give me 110 crores worth of stock, I'll give you 55 crores. Right. Suddenly it was not attractive anymore. So you found this as a way to break leverage, you went on. But there's still an item. I'll give you an example. I have 100,000 shares of TCS. I go to the market and I tell you, Shray, you're a broker. I'll give you this 100,000 shares of TCS. You sell them. And what I will do then is, as a client of yours, I will buy 100,000 futures of TCS. Now, to finance that 100,000 futures of TCS, I have to give you cash of only maybe 6 crores, 20%. Yeah. Out of that, half of that can be in stock, but assuming that I gave you even the 6 crores, you would give me 24. So where a bank is giving me max 1 crore, the NBFC is giving me max 15 crores, where even a bond market is max giving me 15 crores, I am able to go to the stock market and get 24 crores of money for the same thing. I am long the futures, you're short the futures. If the stock goes up, you have to pay me. If a stock goes down, I have to pay you. It doesn't matter because we're both known to each other and you're now financing me. How am I paying the interest? Every month I roll over the future at a slightly higher cost. You get an interest rate for it.
So you still managed to, in this hypothetical example, you retain the exposure to the TCS shares that you had and you've got this amount of leverage.
Yes. And
the broker's happy because the broker's getting like business and whatever. Yeah.
20%. And fairly great guy called Sharad Shah is a person who revealed this to me. And I was like, my God, this is right. Because, okay, who's behind this? Who finances these trades? There's 169,000 crores worth of futures open as of this moment in the stock market. 169,000.
Which is fine.
Which sounds great. But here's the thing. The guys who actually manage this entire settlement process on the exchange is the National Stock Exchange Clearing Corporation.
Well, at least we have one. At least we have one.
And they reveal their results every quarter.
Okay.
In that quarter, they tell you there's something called a settlement guarantee fund. As of December 2020, this fund is about, around 3,400 crores.
That's like 2%, right?
So if you forget the stock market, forget anything else, just take the futures open interest, 170,000 crores. They have only 2% of it, which is 3,400 crores as capital. Now, banks in India are required to have 10% capital against the loans they lend. It actually means if out of this 170,000 crores, if 3,400 crores goes bad, the settlement guarantee fund of the clearing corporation is finished. Now, how does it settle? Basically, let's say there are let me give you an example. There are 3 stocks, Bharti Airtel, Reliance, and I don't know, third one,
HDFC Bank.
ICICI Bank. Yeah. The futures against these 3 stocks is 5,000 crores each, right? There's 5,000 crores worth of exposure each. Let's say all 3 of them fall 20% in one day. That's just the 3 of them. That means that each of them sees a 1,000 crore fall. So the guys who are short the futures must get the money. The guys who are long the futures must pay the money. For some reason, these brokers of the clients who are long these shares find that their clients are bankrupt. They've taken some money as an advance, but it's not enough. And they end up losing maybe out of the 3,000 crores, they lose 2,000 crores. The brokers themselves don't have the ability to pay, so they go bankrupt. Now, who pays the 2,000? The answer is the settlement guarantee fund of the clearing corporation, which is only 3,400 crores. So you've lost half your money on just a 15,000 crore exposure going down 20%, which is such a tiny thing. So imagine if the whole 170,000 crores sees a shake-up of say 10 or 15%. The settlement guarantee fund is in no way enough to be able to cover the damage that a steep fall has caused. We haven't seen this in the recent past affecting us. But tomorrow, if it did, would it be because we were blind to the fact that this kind of leverage exists? The answer is people can go to the market and borrow at 80%, which means putting only 20% down. The fact is that there's 170,000 crores of futures in the market, open interest outside, waiting for in the system. The fact is that the only thing backing this whole thing, of course, apart from a broking infrastructure and so on, is a settlement guaranteed fund, which is only 3,400 crores. Why are we not mandating a much higher settlement guarantee fund of, say, 10,000 crores? Even a 17x leverage is much lower than a 50x leverage. Currently, we have 3,400 crores. So sometimes these things are not visible to us. But when things really go bad, they'll go back and say, oh my God, why was it only so low? So our regulations may be very good, but I don't think they're enough yet. And we're going to need more. The SEBI is constantly working. So they've tried to reduce intraday leverage.
Yeah, I saw that today. Yeah.
And they've reduced intraday leverage already twice. In another 6 months, we're going to see intraday leverage reduced by half again. So today you can have a maximum of 10x leverage. In 6 months, you can have a maximum of 5x intraday leverage. This is great because systemic leverage coming down is a good thing. The same thing with a lot of other things that the RBI is doing, which is helping bring down unnecessarily excess leverage. Some of it is in the form of, they haven't yet cut, for instance, housing leverage. We have a stock like Dewan Housing. I'll give you an example of what happened over there. So what happened over there was that the NBFCs were told, if you lend 10,000 crores, you got to have at least 1,000 crores in capital. And Dewan Housing said, listen, I have 1,500 crores in capital. How did it generate that capital? Take a very interesting instance. They took this company they had, which was DHFL General Insurance or Life Insurance, or one of them, I forget what it was. And they said, listen, we are going to sell our stake to this buyer for 4,000 crores. Everybody clapped and said, fantastic, because after tax, you're going to get 3,000 crores and that's going to sit on your balance sheet. It's going to give you the ability to, basically show great capital ratios. Except the buyer was a company called Vadhavan Capital, which is owned by the same founders as DHFL. So what was this deal? Vadhavan Capital had to now pay 4,000 crores to DHFL. I don't know the exact number, but I'm giving you the...
Sure. Okay.
So they got 4,000 crores and paid it to DHFL. Where did they get this 4,000 crores from? They went to a mutual fund and said, listen, we'll issue bonds because we now own this fantastic insurance company. The mutual fund started laughing their heads off. When they stopped laughing, they said, listen, give us more than an insurance company. We have no idea what that means. So they said, listen, here's the deal. We've bought it from DHFL, which is our own company. And we made a deal with DHFL saying that, listen, in 2 years, if we're not able to find an external buyer, DHFL will buy it back from us. So DHFL gets the 4,000 crores through this angle of these mutual funds financing Vadhavan then paying DHFL. The mutual fund's only contention is, listen, if these guys can't sell this insurance company, and we know that DHFL will buy it back. For DHFL, the point is this. I now have 3,000 crores more capital. I pay tax on that 4,000. I get 3,000 more capital. I can now lend 10x that. So I can do a lending of 30,000 crores on this capital. But this capital is not really capital because there's an obligation to buy it back.
So when this works out, that 30,000 crores will generate enough profits to be able to manage all of this.
Yes, except it didn't. And DHFL went bust. And eventually all of these shenanigans have come out. And this is one of the lower end of the shenanigans. It turns out there's more shenanigans on the inside. The point is not that. Point is that you created leverage because you now lent 30,000 crores plus the original 10,000, 40,000 crores against what a capital of only 1,000 crores was. The remaining 3,000 was quasi-capital. It wasn't really there. So you actually generated a leverage of 1,000 into 40 times where everybody else got the impression it is 4,000 into 10 times. And this is where the problems in the system lie. Every of India's past problems as well, whether it was Harshad Mehta, remember the scam. The scam story is now coming out, but he had money that was unofficially leveraged. So when I say unofficially leveraged, he had 500 crores that SBI had paid him. That money was supposed to go and buy government securities. Government securities would take 20 days to arrive. So Harshad Mehta said, listen, why don't I use this money for 20 days? And he would go speculate it in the market. He went and bought a bunch of shares whose prices started to fall. Now, he could have sold them and generated the 500 crores required to pay back SBI, except there was a strike, maybe engineered, in the stock exchange. He couldn't sell those shares. SBI, meanwhile, got to know and placed a complaint. Harshad goes to jail, from where he cannot now sell those shares because they have been attached. Now the stock market may be open, he can't sell them, stocks are very low. He tries to make a deal with somebody at Citi, and Citi says, well, we'll give lowball a price for it, just about enough for you to just survive. He doesn't take the deal, the whole system falls. Undisclosed leverage. Nobody knew where the leverage was, but everybody knew the system was tremendously leveraged. That was not all. It was more stuff like this that happened at Ketan Parekh, more stuff that happened with DHFL, with Karvy, so all of these cases are small pieces of undisclosed leverage that has just resulted in the system weakening. And in India, at least, that fragility has caused the regulators to build on more fortresses of defense. It may hurt a few people who will say, listen, how can we do it without intraday leverage of 50 times? The answer is, well, you're going to have to, because what the regulator is doing is protecting against that massive fall, which each of these chinks open. But what is the American regulator doing? Nothing. And like we've talked, it's not like America, if it goes down, if the American markets were to go down, that India would be
unimpacted, far from it. So that's a very worrying note to end on. We're working very hard to make sure things are under control here, but we're still too exposed. And as you said, there's still hidden leverage here as well. So I, for one, really, really hope you're wrong, and that all of these turn out to be one-offs. At the Biden administration or the US or whatever over here, we managed to keep these as the stray anecdotes that never materialized and became a giant snowball down the hill.
I hope so too, man. Because the problem really is you can always predict a doomsday.
Yeah.
But the only reason why I am worried is because three things happened one after the other in this one quarter. And I'm wondering if that's 2021 for us, the first 3 months, what else? I mean, you've had riots in the US White House. You've had situations which you never imagined in the last 1 year materializing. And suddenly you're staring at the rest of this, rest of the financial system and saying, oh, well, it's all fine. Let's just go buy stocks forever. There's a little more in it than I think we're going to be expecting.
Right. Well, Deepak, on that ominous but watchful note, let's hope that just keeping good care of all our customers' portfolios, and that we're all able to sidestep whatever carnage comes up ahead.
Yeah, I hope so too. We're scared, but we got to react more than predict, because prediction doesn't seem to have worked in this market in a meaningful way.
At all. On that note, thanks very much, Deepak, and thank you everyone for listening.
Thanks, Shray, and thanks again. Thanks all for listening to the Capital Mind podcast. Yes.